All right, let's dive into one of the most powerful and, honestly, one of the most dangerous tools in all of finance: leverage. This is a concept that has built massive fortunes and completely destroyed others. So, how does this thing actually work?
Let's just kick this off with a big question. How in the world do you get to control a $1 million asset when you only have a tiny fraction of that in your pocket? It sounds a little like magic, right? But it's the central promise of what leverage can do.
And the answer lies right here in its core idea. You see, leverage is this fundamental mechanism that can put everything in finance into hyperdrive.
At its heart, leverage is really just about using borrowed capital. Yup, money that isn't yours, to ramp up the size of your investment. You put down a small amount of your own cash to control a much, much larger asset. Think of it like a financial accelerator pedal pressed to the floor.
You know, the best way to picture this is to go back to your high school physics class. Remember the lever? It's the same principle. A small, focused amount of effort on your part, that's your capital, can move something absolutely enormous, like a massive investment. It's all about multiplying your power. So what's the big promise here? Why are investors and companies so obsessed with leverage? Well, it all comes down to its incredible, almost unbelievable power to amplify your returns.
The motivation is actually pretty simple. It's a deliberate strategy to make your capital work way harder. By using borrowed money, you're suddenly not limited by what's in your bank account. And the justification for taking on that risk? It's always about the potential for those significant, outsized gains.
Okay, let's make this super real. Imagine you invest your own money, and the market has a good day. It goes up by 10%. That's a great outcome.
You get a solid, respectable profit. You made money, which is fantastic. But it's what we call a linear return. Your gain is directly tied to how much you put in. Pretty straightforward.
Now, hit the rewind button. Same market, same 10% gain, but this time you've used leverage to control a position that's 5, maybe 10 times bigger than what you actually put in.
Suddenly, that same market movement doesn't just give you a solid return, it can create an explosive, absolutely exponential return on your original cash. This is the magic of what traders call amplified yield.
But, and you knew there was a but coming, right? This is a huge one. The lever works both ways. The exact same force that amplifies your gains is just as powerful, if not more so, at magnifying your losses. This is the peril of leverage.
Just look at this. These are the two faces of leverage right next to each other. For every incredible promise, there's a corresponding peril. That amplified yield comes with risk magnification. Increased exposure means high risk. And that amazing potential gain is always shadowed by the potential for a complete and total wipeout.
So, let's go back to our scenario one last time. You've used leverage, but this time, instead of the market going up 10%, it just dips down a little bit.
And that small dip, it creates exponential losses. Because you're on the hook for all that borrowed money, a minor downturn can eat through your initial capital at a terrifying speed. It's no longer a linear loss. It's a downward spiral.
If the market moves against you enough, you don't just lose some money. You can lose every single dollar you put in. The debt is still there, but your capital, it's gone. This catastrophic outcome has a name.
A wipeout. That's the ultimate risk of leverage, the total, complete loss of your investment. It's what keeps risk managers up at night, and it's exactly why leverage has to be handled with extreme caution.
Okay, now that we get the theory, the amazing promise, and the terrifying peril, let's look at how leverage actually works out there in the real world. Where is it being used every single day?
Generally speaking, you can break it down into two main arenas. First, in the day-to-day operations of businesses trying to grow, and second, in the super fast-paced world of financial markets, where it's all about speculation. In business, leverage can be really simple. A company takes on debt, a loan, to build a new factory. That's leverage. But it can also be more subtle. Think about a company with high fixed costs, like rent. As their sales go up, their profits grow way faster because that rent cost stays the same. That's called operating leverage. And then on a massive scale, you have things like leveraged buyouts, where entire companies get bought using staggering amounts of borrowed cash. Now, in financial markets, leverage is even more direct and in your face. Traders can borrow from their broker to buy more stock. That's called trading on margin. They can even borrow shares just to bet that a stock's price will go down, which is known as short selling. And then you get into complex stuff like options, where an investor pays a small fee to control a huge amount of stock. But the key idea? It's always the same. Use a little to control a lot. So, after seeing both the incredible power and the immense danger, what's the big takeaway? It's that leverage isn't inherently good or bad. It's a tool, and its value depends entirely on how it's measured and, more importantly, how it's managed.
So how do we measure it? Well, one of the most common ways is the debt-to-equity ratio. This simple number tells you just how much a company is relying on borrowed money compared to its own funds. A high ratio? That screams higher risk. It's like a quick snapshot of that balancing act.
But, at the end of the day, using leverage effectively isn't just about the math. It really means you have to step back and ask a very, very fundamental question about what you're doing.
And that question is this: is this leverage actually building something sustainable, something that creates real value? Or is it just a gamble, a roll of the dice that's just magnifying risk for a shot at a short-term win? The answer to that question is everything. It's what separates a sound strategy from a reckless, catastrophic failure.